Hello, everyone. Welcome to today's webinar, 3 Tax Compliance Hot Topics Software Companies Can Ignore. My name is Melody Payne, and I'm the Senior Marketing Manager on our Customer Marketing team. I will be your moderator today. We have a great agenda and 3 awesome speakers for you. But before we dive in, I just want to give you guys a couple of housekeeping items. The first one is that your lines are going to be muted, but if you have any questions at any time during a webinar, please use your Q&A chat box to chat it to us. We'll collect that and save it for the speakers at the end. The second thing is that this webinar is recorded, so you will receive all the webinar recording tomorrow from On24. You can feel free to share that with other people in your organization. So today we have a great agenda prepared for you. We're going to be covering 3 challenges that are facing today's software companies around sales tax compliance. John Solis, our talented tax consultant, will be covering them. And after his presentation, we'll have 2 great, awesome Avalara customers that will share their experience with you. Jason Heckel from Zillow and Dennis Stewart from One Step Retail Solutions. We'll leave plenty of time for Q&A, so feel free to use the Q&A chat box at any time. So John Solis is going to kick us off. He's a tax consultant at Avalara and has extensive knowledge on tax and systems. He has 20-plus years of experience working at the Big Fours and other software providers like Vertex and Taxware. We're really lucky to have him today. With that, I'm going to pass it to John.
Hey, thank you very much, Melanie. Today we're going to talk about some common triggers for software companies as it relates to register and filing for sales and use taxes in other states. And we're basically just got a few things here about have any of these triggers actually tripped up your company in the past. And so we just got some bullet points here. But typically if your company is involved in a merger and acquisition, when you're couple of companies are combining, or even maybe if you're divesting some of those companies, there's some certain tax considerations that come up during that process. We actually have a slide after this to talk through a little bit of that, but whenever you're combining companies with different nexus statuses or different points where they're registered in different states, it can be a little challenging sometimes. Some other areas that can tend to trip you up is when you we have there added add online or what we call a SaaS model, and SaaS stands for Software as a Service. Work with a lot of companies, and in my job here at Avalara and at other companies I've worked with, I work with a lot of software companies, and software companies that have been around for a while, and they have that traditional premise-based software model where you buy software and you get a license to it, and you download that software and use it locally. A lot of companies have been trying to transition from that model where you license and get the software to an online model or a SaaS-based model. And the tax rules change, right? States haven't even really figured out a lot of the times on how they actually want to tax that stuff. So a lot of opportunity for changes and understanding on how that model needs to work and how you should be taxing it when you start going into that market. And it also can affect in what states you're registered. And again, we'll be talking about that a little later on. The third point there talks about adding new staff. Whenever you add new staff, it gives you the opportunity to maybe get Nexus or the requirement to register for sales and use taxes in another state. And again, at Avalara, I talk to a lot of companies, and I talk to a lot of growing companies. And one of the common misconceptions out there is, hey, I've hired a new staff, and I hired it, and it's the only employee I have in that state, so I'm not going to worry about it. And the reality is that you probably should be worried about it, and it's something you should be thinking about as far as if you need to register or not to start collecting taxes there. This other point here, launch new or expanded products or services, relates a little bit to adding online or SaaS services. But whenever you launch into a new product offering or product line, always the issues that can come up usually are around, how do I tax that particular, product or service, and do I have an easy way to figure out when and how things need to be taxed? And again, common questions I get a lot from customers. Whenever you start engaging in business with new channels or different partners, again, you typically tend to start visiting other locations on a regular basis, so you sort of need to think about and keep track of that to figure out if I need to maybe look at how I'm registered out there for collecting tax. One of the real common areas that come to me anyways in my business is when customers shift over from selling maybe from a wholesale model to shifting over to selling direct to customers. The trend out there right now is, a lot of companies that traditionally sold to distributors and then the distributors would go ahead and sell to the end customers. Those were typically all done, through resale certificates. So there wasn't a huge demand for taxing to the end customer. The trend lately has been a lot of those companies are shifting and saying, hey, you know what, I'm going to sell, I'm going to open up a website or a marketplace of some kind, and I'm going to start selling direct to my customers. So they're kind of shifting. They never had to worry about selling or charging taxes to those ship-to locations, and now all of a sudden, it's becoming an issue. They need to start thinking about it. Last but not least, opening up a new office or a new location can trip you up a little bit. And that new location can simply be you hired a sales rep, right, in another state, and they have a home office somewhere. Or going back to that merger and acquisition discussion we were just having, if you do a merger and acquisition, usually you have a lot more offices and a lot more physical locations than you did before. And when you start combining all those locations, you tend to expand your nexus. Shifting over to the next slide here, we actually have a couple of poll questions in here we're going to be talking through. So if anyone could just take a second. The question we're asking today here is, what nexus trigger has your company experienced in the last 24 months? If you've even experienced one. We've got some options here. We're just looking to see, you're doing any M&A activity. Have you added a new online or a software as a service channel, new staff, that kind of thing. Or obviously, you got the bottom options there too. Do all of these apply, or maybe you haven't done any of these? If everyone could just take a few seconds and check those boxes accordingly. Oh, interesting. So we've got some results here. New staff, it looks like, which typical. New staff seems to be the majority of it. A lot of companies tend to add new staff, and certainly can be a nexus trigger for you, depending, of course, on what states they're in. Thank you, everyone, for answering those questions. Moving over onto the next slide here. Wanted to talk a little bit about mergers and acquisitions is one of those triggers a software company might have to deal with. And I kind of alluded this to a little bit on the previous slide. When two companies combine, there's all sorts of tax issues that come up. Sales and use tax just being one of them. A lot of state income tax and sales and use tax issues come up when you start combining companies. And having worked with and at various companies after, a merger and acquisitions occurred, record retention tends to become an issue. No one in the company tends to want to deal with record retention. It's been my experience anyways, until after the state auditor shows up, when you're actually trying to find it. And it definitely can become a challenge. I've dealt with situations where they actually had to put the information in a retention repository, and basically they archived it off-site, and that there was a fire there, to just not being able to find the records at all. Typical things that tend to go missing are actually the exemption certificates. A lot of companies tend to not review those prior to the acquisition, or even if they were reviewed prior to the acquisition, no one actually collected them all and stored them somewhere so that they actually could find them when the auditor showed up and needed them. But again, just some of the common triggers a software company might need to address. Going over here to the next slide, and sort of moving over to point 2 from the beginning of our agenda there, is the taxability of SaaS. And again, SaaS stands for software as a service. It's typically, you log into a central site on the internet to get information. And SaaS is one of those areas that has gone through a lot of changes over the years. And as far as taxing goes, states have been getting a little creative on how they want to handle that from a tax perspective. This chart does a nice job of sort of highlighting some of that. And, we're talking about the taxability of SaaS, and software is taxed, as it says there on the bottom there, software is taxed approximately 450 ways across the 45 different categories. What we're trying to highlight there is that downloaded or premise-based software, which typically, premise-based software is typically like the physical media, which could be the CD, which isn't very common anymore. But if you bought that CD, that actually has one treatment because the states usually consider that piece of media, that disc, to be the taxable property that you're buying, and they want to go ahead and tax that. But if you download that same software, there's a different set of rules. But you still have software, right? You still have that tangible thing you're downloading. So states sometimes want to try to assign some taxability to that. But when we start talking about SaaS services, it's a little different, right? You're not actually downloading anything. You're going into a web browser and you're logging onto a website and you're looking at information, you're getting information, but you're basically paying for a subscription to use some data out there. And a lot of states have interpreted that a little differently on how they want to tax it, and this chart here does a nice job highlighting some of that as we look through it. As I scroll over to the next one, though, I just wanted to have a second question for you. In general, how would you categorize what your company sells, in terms of software? And again, we got some options there. Feel free to go through and click one of them. Give you a couple of seconds here. I'm just going to go ahead and scroll through the next one. And wow, high percentage of software as a service. All right, moving over to the next slide here. A software license may have no actual association with physical presence, as we were sort of mentioning, but states still want to have their cut, right? Whenever you can't tax something, states look for some creative ways to try to, encompass that into something they want to tax. And some of the stuff I've seen out there, if anyone has ever heard the term, that first point there are MPUs, or multiple points of use. And what some states have been looking to do, and some customers actually, if you're a SaaS company and you sell to a large enterprise organization, is they actually don't necessarily want you to tax it all at one location, right? Because they recognize you have a software license, and the example that always comes up is like for Microsoft Office. You might have 100 licenses for Microsoft Office. It's all online, and your corporate office might be located in Washington or the state of Washington, but it's not necessarily where it's always being used. You might be using it in 5 to 20 states. So do you actually want to be taxed at that one location, or do you want to have that tax spread out across multiple locations? Avalara, as a SaaS company, that we actually have to address that conversation quite often. And there's various ways states want you to handle that. There's actually have exemption certificates and specific rules around that in some of the states and how they want to tax it. Texas has gone so far as to say on the bottom there, the taxability of SaaS, what they're saying is, well, you might not have Nexus with our state, but you know what, if you're using a software license for a company in that state, they're actually trying to make that as a, you know, a Nexus creating event, basically, meaning that you might have to actually start charging taxes in the state because you have a customer there using your software, which they're considering is enough to cause that trigger. One of our next questions are, you know, do you sell internationally? So, simple question for you. Yes or no? We're trying to figure out if how big of a concern international taxation is for you. And I'll just give everyone a couple of seconds to go ahead and answer that. Majority of us up here apparently are going to be selling all that good stuff internationally. Just going to hit next. You know, I just have one slide here to talk a little bit about selling software internationally. Going to our third point, selling software cross-border. You know, right now, 39 countries that require VAT collection for B2C digital service transactions. And, excuse me, if anyone's referred to the, or knows of the old rules for digital software, you know, prior to 2015, when you were selling software as a service model, it was, you know, usually it was based on where your company was located. The rules were more centralized on where you were located as a company. They shifted all of that 2015 and this for B2C transactions, and they're saying, hey, you know what? We want you to now tax based on where the customer is buying, where the customer is downloading that software. Which for the EU, it's in the US, we're like, probably didn't think it was a big deal. But in the EU, you know, more of a big deal for them. Now they actually have to keep track of where customers were, where they were downloading, and they also had to deal with the whole reporting issues around that. They did come out with some simplification models over in the EU to try to address that, and they called it MOS, if anyone's heard the term. But it's in order to make collection a little easier in the EU, companies had the option of registering for what they called was MOS, which stands for Mini One-Stop Shop. And then when you sell certain digital services to consumers, not businesses, but consumers in the EU, you have an option of centralizing how you would actually report and file those VAT taxes to all those new jurisdictions you were in. Again, it was a little bit more of a simplification method for them. That was what we had planned on the initial topic here as we were talking about common triggers for software companies. Talked a little bit through the taxability of SaaS and selling cross-border. But now to give a little bit more of a practical element to it, we actually brought in some panelists, and I'm going to actually turn this over to Melanie to introduce some of our panelists and continue the discussion.
Thanks, John. Thank you so much for all the great insights. Like John said, we're now going to transition to the customer panel portion of the webinar. I just want to give everybody a quick intro of our panelists today. So today, the first panelist is Dennis Stewart, and Dennis is the accounting director from One Step Retail Solutions. It's a point-of-sale software provider based in Arizona. They've been with Avalara since 2012 and have our flagship product, AvaTax. They have Nexus in 7 states. Dennis has a ton of finance and accounting experience in a wide variety of industries. Dennis, thank you so much for being here.
Thank you so much, Melanie.
The second, yeah.
Go ahead.
Oh, sorry. The second panelist today is Jason Heckel, Senior Director of Tax at Zillow. Zillow is based locally here in Seattle and a leading real estate marketplace. They've been an Avalara customer since 2014 and have our AvaTax and returns product. Before Zillow, Jason spent 14 years in both public and private sectors. He was one of Zillow's first tax-related internal hire. Jason, thank you so much for being here.
Thanks for having me.
Awesome. Okay, so Dennis is going to kick us off, and the first question Dennis is going to answer for us is related to Nexus triggering activities. So, Dennis, can you share maybe an experience that you had around Nexus triggering activity, that one-step experience in recent years?
Sure. Our biggest trigger has been last year we made a large acquisition of a company out of Massachusetts. We did an asset acquisition of not only their clients but also their employees. We just physically located or relocated their offices across the same building. What some of those challenges were for us is having to not only, of course, look at the Massachusetts situation and what their requirements were, but also to make sure to look at the surrounding states. Many states have nexus points based upon how long a technician or a salesperson travels to their states. So that's was a big issue for us, of locating all the surroundings and figuring out what those nexus points were. In addition to, it's the exemption forms. A lot of times, as John pointed out, you've got the record retention issue, and a lot of times when you do acquisitions, companies will have reported that they've got exemption forms on file for their clients. However, they don't actually retain or have filed away those documents, and so making sure they go back and look at all of their clientele and ensuring that you've got those proper exemption forms is a major critical issue.
Great. Thank you, Dennis. And how would you how do you stay on top of taxation requirements for SaaS, and how do you leverage Avalara's solution to support one step in this?
Staying on top of taxation requirements, and specific in the SaaS environment, is always a challenge because every state, it seems, has new rulings or new positional statements or actually new laws that go into effect periodically throughout the year. A lot of it is staying in contact, direct contact with Avalara and their customer service point. Checking all the time is one of the biggest things that we do internally. We always look at our sales. We look at where those sales are located at physically, and then going to those states and just a periodic check of their taxation laws to ensure that we're following the requirements. Some of them that we've got flagged, of course, we know about Texas. Arizona actually has partial products that are cloud-based that are now a taxable product. So a lot of it is just keeping your information up to date all the time.
Great. So last question, Dennis, can you share a little bit with the audience here on kind of your approach to evaluate risk when it comes to tax compliance? Like, how do you think about it?
Evaluating your risk is always a key component, because you have to assume that wherever you may have Nexus at, you've got a potential liability when it comes to financial on the bottom line. Whether it's one sale for $10 or one sale for $10 million can have far-ranging implications on that. A lot of times it's the small sales you can kind of monitor and verify and say that, well, our liability is so small that it's not necessary to dig into the nexus points in that state. Whereas any large sale, and you have to look specifically at where the sales were conducted at. We take part in trade shows throughout the country, and some states actually have a trade show nexus at where if a sale is conducted or consummated on the floor of that trade show, it now provides a nexus point within that state. So you have to be very, very conscious on what's going on. One of our key ways to look at that is that we're always working with our sales department in looking at not only the products they're selling, but how they're selling them and where they're selling them at. And when you become comfortable to that point of saying, we are now passing a threshold, it may be a couple $100, it may be a couple of $1,000, at where we need to evaluate our financial aspect to it and say that we do need to register in that state and we do need to begin reporting on all of our transactions.
Great, thank you so much. And audience, if you have any questions specific to Dennis, feel free to chat it in the Q&A box, and we'll save them to the end. But thanks, Dennis, for sharing your experience and giving some insights here. All right, so Jason is up. And Jason, same question to you. Can you tell us a Nexus triggering activity that Zillow had experienced in recent years? What were the challenges and learning from your end?
Certainly. In my now 4 years of being here at Zillow, we've done, I think, 10 or 11 acquisitions. And so with each of those, and John alluded to a few things, you have to reconsider both Nexus and taxability, and really just get into the guts of understanding the the service offering or the product offering that the company you're acquiring is coming through with. In our case, being a public company, it's especially kind of high profile when larger acquisitions occur. And so when we bought Trulia back in 2015, this was one that was a highly publicized acquisition. In fact, we ended up under audit from the state of New York simply because they saw it on the news. So it was large profile. We knew it was going to be well in the news, us acquiring basically our largest competitor. And their offering in a way was very similar to ours, which is why they were a large competitor. And so really it was getting in front of one, a little bit of looking at how are they looking at Nexus and taxability as compared to what we had done historically, but also it was a stock acquisition, and so thinking about contingent liabilities and potential liabilities that we were taking on was a massive undertaking, and so this was a great event in some ways to get kind of a high profile to sales tax, because often you just don't get that, right? Salespeople want to make sales. They're not worried about the taxation. They're not worried about the qualification of whether something is a service or a product or a good or a SaaS product. They're out just to make sales, and that's a big portion of what we do, is work with real estate agents on kind of a online business bundled service. And so that particular acquisition really was such a big profile that it got everyone from management at the top all the way down going, we need to make sure we nail this correctly. So that was a good chance for us to kind of really dig deep into our own stuff, but also an opportunity to play off of what Trulia had going on.
Great, thank you, Jason. Second question, how do you stay on top of taxation requirements for SaaS, and how do you leverage Avalara's solution to support your effort around this area?
Yeah, SaaS is, and John mentioned it too, SaaS is a tough one in that what really is it? And that definition is a strange one. Because just purely the way we describe a product in our legal agreements, helps drive some of those answers. And so concerns with SaaS from my perspective, we have a lot of bundled services. So there are components that, are online advertising, but we also have SaaS products involved in there. And so looking at how states are targeting bundled services and pulling apart SaaS components of that is highly important to us. From a Nexus standpoint, click-through Nexus and economic Nexus drives a lot of that reporting. And so a software offering where we may not have people, but we have click-through Nexus, gives us an issue around needing to file. And the other thing is, a lot of the states, they don't even really know what they want or should be doing with it. There's numerous court cases where the courts have come down completely against what is stated very simply in the law. And so there's this kind of ever-growing uncertainty around, well, what am I supposed to do? Do I follow the law, or do I look at court cases on specific fact patterns that fit me maybe closer than just a generic tax law? And it's come down that it's not taxable, even though it's clearly in the law. So it's constantly looking back through state laws, staying up to date through different research tools. working with Avalara, looking through each month, utilizing the AvaTax platform, looking through and actually kind of, obviously checking some of the taxability before we go on to the filing side, but kind of looking for those variances and trying to understand, as the Avalara model adapts to changes in law, it's really through that process that we can also identify potential items.
Thank you, Jason. So last question, tell us about kind of your approach on risk and how you evaluate risk and how you talked a little bit earlier on, evaluating income streams with acquisitions. Like how do you think about risk and what's your approach?
Yeah, as kind of from the M&A side and risks there, you kind of step into the shoes of owning a company, and you want to make sure that you've accounted, in your financial statements and otherwise for any potential liability. But the risk side, from our perspective, we value very strongly a great customer relationship and the idea of potentially having something that ends up taxable and now going back to customers to try and collect, which in a lot of cases you can do. There's no appetite here to do that, really. It's one of those things where if something comes down taxable and there's back taxes due, they're probably coming out of our pocket. And so when you talk about 5, 6, 8%, sales tax times revenue, right? Not profits, right? We've been in losses since inception. That can be a massive number. And so staying ahead of that and working with the revenue stream. So I spend a lot of my time with the sales and biz ops teams to understand, okay, what is the revenue stream here? What is the product that we're looking to do? Zillow is a very entrepreneurial company, which is fantastic. And we try to monetize whatever revenue streams we can, but really staying in front of every single one of those and understanding what it is, and then working with the IT financial operations side to make sure we have a billing platform that can work with AvaTax in situations where we think we need to tax something.
I guess you wouldn't be very popular if you went back to all your customers and wanted to get back taxes, huh?
It's one, you become very unpopular. Two, the nightmare of that, we have probably 25, 30,000 real estate agents that work with us each month, and going back and trying to bill for that would just be a massive undertaking. So you become unpopular and then there's always a question of you calculate it correctly and apply it to everyone correctly. That alone would be a huge undertaking.
I get you.
No worries. Sorry, Melanie. Go ahead.
No, thank you. Thank you, Jason. Thank you, John. So we're open for Q&A. So if you have any questions for Jason, Dennis, or John, please feel free to use the chat box. And I actually do already have some questions that came in during the presentation. So I'm just going to send them to the speakers now. So John, I have one for you. Audience is wondering what constitutes data processing versus SaaS. Any of you can sort of help them define that?
That is so. Let me start. So data processing is an older term, and it came about when companies when the mainframes were big. There's an argument that a mainframe is the same thing as SaaS, but when mainframes were popular, people used to use a mainframe to do their processing, right? So they would do their batch processing with a mainframe, and they wanted to know how to tax that. And some of the SaaS rules out there, or software as a service rules, do follow the data processing rules. One of them that comes to mind, because it's a little unique, is Connecticut with their 1% rule. They apply to some of the SaaS services. I'll let just to give the history. Does anyone want to take a little bit on the differences between the two? Nope.
Can you repeat that? What
No
are the
worries.
differences between?
Oh, I'm sorry. If anyone wanted to take a shot at the difference between your opinion, I guess, on the differences between a SaaS service and data processing.
Data processing always comes to me as the actual service of a service that's being done remotely or offsite or at another location. Whereas a SaaS is going to be, we have a SaaS product that we provide, whereas it's mainly a cloud-based solution that's on a hosted server where the clients have access from any of their locations into the software itself.
You got it. And typically speaking, and this is sort of they're generally treated the same most of the time. There are some differences between, from a tax perspective, they're usually treated a lot. There are some where they're called out differently because of who owns the software, right? Because a SaaS service, usually you're logging into something you have a software license to, and data processing tends to be using someone else's system to do something. But I don't know if anyone else had other comments there. Oh, I think we're good, Melanie.
Yep.
Okay, cool. So, John, back to slide 11 when we talked about selling software internationally. 39 countries require VAT collection for B2C digital services. Can you share maybe a little bit more insights on B2b tax liability in the EU?
Oh, sure. Yeah, B2B services are still, the taxing or how those services have taxed on the B2B side has not really changed that much over the years. The real change was on the B2C side, where they actually wanted to tax at the destination where the software was being downloaded. It was kind of the same. It was always treated from a B2B perspective. It was treated on where the software was delivered. There's generally no, on the B2B transaction, there's generally no tax on the person billing. It's usually on the person receiving it. But the same concept. It's still generally a taxable offering in most countries in the EU.
Thank you. And this question, I think, could probably apply to both John and Dennis, because I think, Dennis, you talked a little bit about employee Nexus triggering activity. So the question is Nexus triggered by an employee taking up residence in or visiting a state, or when the first sale is made?
I can probably talk to that a little bit, and it's just from our experience of our acquisition of our company back there in Massachusetts. And I'm trying to make sure I'm remembering this correctly. New Hampshire, I believe, has a Nexus trigger that is based upon X number of percentage of workable hours that a salesperson or technician is traveling within their state. I want to say it was, and again, I'm trying to remember from memory here, I want to say if they traveled for more than 500 annual hours, workable hours in their state, either conducting sales or actually working on a client's systems, whether it be hardware-related, software-related training, or anything like that, if we physically had a person located in their state, that then constituted a trigger for Nexus. So a lot of it is you've got to be very, dig into the state's DOR regulations. There's nothing wrong with also requesting an anonymous ruling, just to be very clear on what it is. We've actually done that previously in Arizona to find out what the actual DOR's recommendations are. It sometimes can take a little bit of time, so you got to take it into consideration, but you can actually request that information directly.
Very good point.
That's a great tip.
Yeah. Generally speaking, all the states have, like, if you physically put somebody, they usually have a time requirement of some kind, and it varies by state. The favorite thing a tax person can say, right? It varies. But each state generally does a good job defining, based on the activity and the amount of time in the state, what those Nexus requirements may or may not be. And of course, that would certainly be something that you should probably take a look at. There's companies out there that do what are called Nexus Studies for you. It's something we offer here at Avalara. It's also something a lot of our partners offer. where they'll actually look at your activities, look at how long you're in the state and what you're doing in the state, and they'll certainly come up with if they feel you need to be registered there or not.
Great. And I think this question is for John. So it reads, most of our customers are manufacturers who provide a sales tax exemption certificate to us. Our software is used in the manufacturing process, i.e., it runs machinery. Most states exempt manufacturers or assemblers of personal property who resell what they make. Am I covered, Nexus or not, with the exemption certificates on file?
I'm going to read into that question a little, and it has to do with, if the sort of I think what they're asking there is if I'm doing a lot of business in, let's say, California, manufacturing, which is a bad example. Let's say we're doing a lot of manufacturing in Illinois. You're doing the manufacturing there. You're not registered there, but maybe all your customers are exempt because you don't sell to the end user. Should you be registered there because you're getting the resale certificates? And I think that's what we're asking. And the answer is you should, regardless of how much tax liability you have in a state, you should be registered there. If you have Nexus with a state, you should register. The question is, how often do you file the tax return there and how much tax dollars are on it? If it's zero liability, you're filing a zero tax return every year. If it's small, you don't have to worry about it. But you would still, the question if the type of customers you do business with and if you're required to be registered there as a customer or not, it should be treated as two separate questions. I think that's what they were asking.
I think you're right, John.
I would just caveat it. I would just caveat it with a lot of manufacturers, depending on the state you're in. There are some states that don't necessarily always exempt it. They have reduced rates associated with it, which is why I sort of stopped talking about California for a second there, depending on the type of work you're doing. There are some states that have reduced rates related to that. They're not always exempt all the time.
Cool. And John, this is a follow-up question, I think, on the kind of difference on taxability between B2C and B2B. So other than sort of the international stuff that we talked about earlier, is there any insights that you could share on taxability between B2B software and B2C software?
B2B and B2C software. Not that I think I'd be getting a little too specific on that one. Generally, I'll say generally speaking, the software is taxable, right, when it's sold. It really depends on the status of the person you're selling to on who actually has to pay the tax, I guess would be the best way to say that. So even if it's a zero, like if you're selling software to a business in the EU and it's zero, technically there's still like a reporting obligation there. Again, depending on how you're doing it, it would just be a zero reporting obligation. I don't know.
Thank you. Yeah, I think it does. The last question I have is, would implementations and trainings be considered taxable? What about employees who come on site for installs?
If you have employees coming on site to do work in any state, and this happens a lot with consulting companies or software companies that offer services. If you have employees going into a state on, I used to say official company business, but if you have employees going on site to do work for you, and it's for I'll call it an extended period of time. Generally speaking, that causes Nexus. The next question is how many days is that? And that's what varies by state. But if you have employees going into a state on a regular and a repeatable basis to do work on your behalf, even though you're not located there, that does cause Nexus. The question is how many of those days are there, and that's when the state-specific rules come into play. I'll bring it one step further. If you have contractors that are going into the state to do work on your behalf, some states have rules around that as well. It says, hey, if they're doing work for you, and there's a requirement they list out, but if they're doing work for you or on behalf of you, and it's over this certain number of days, that too can cause some nexus as well.
Great, thank you. Well, I think that's all the question I've gotten so far. So before we end the webinar, John and Dennis and Jason, thank you all so much. Do you have any kind of final thoughts you'd like to share with the audience here? I mean, these are all people that are dealing with sales tax compliance in their day-to-day, and many of them are Avalara customers in the software space.
This is John. I think I'm good. I think I've expressed myself fully.
Yeah, this is Dennis. No, I really appreciate it. It's John. He was just mentioning about the contractors. That was something that I was back in my mind listening to his explanation, going, "Oh, please mention contractors." We do exactly that. So I think everything I've got is pretty much covered as well.
Yeah, and the only thing I would again reiterate is the longer you wait, the more problems I think you have. So if there's even the thought that you might have some sales tax liabilities out there, it's best to get after it as soon as you can.
Don't delay. You got it. I got you.
Great, awesome. Thank you so much. As a reminder, this webinar was recorded, and then I will share the recording out to all of you tomorrow from On24. And have a great day, and thank you so much for coming. Bye.
Bye.